Welcome to The Explainer. I'm so thrilled you're here. Today we're taking something that honestly often feels like a bit of a dark art, and we're going to turn it into your newest superpower. If you've ever stared blankly at a spreadsheet and just felt an instant headache coming on, well, don't worry. We're definitely not memorizing complex math today. Instead, we're going to learn a new, really empowering language, the language of business reality. So let's just dive right in.
If you've ever felt completely intimidated by financial jargon, you are definitely not alone. Honestly, it can kind of feel like gatekeeping sometimes. But let's just clear the air right away with a really foundational question. What exactly is bookkeeping? I mean, it sounds super formal, maybe even a little old-fashioned, right? But it's actually the starting point for literally everything we're going to talk about today.
Let's strip away all that complex terminology. Bookkeeping is simply keeping track of money-related activities for an individual or a business. That's really it. It's just the organizational solution for tracking the flow of money in and money out. It's basically the act of writing down what's happening so you don't have to rely on your memory, because, let's face it, our memories aren't perfect.
Our roadmap for this explainer is super simple. We've got 4 parts. 1. The basics of bookkeeping. 2. Reading financial statements. 3. The 5 account types. And 4. The rules of accounting.
Okay, starting with Section 1, the basics of bookkeeping, which we can think of as the alphabet.
Every language needs letters, right? Well, in business, those letters are the day-to-day money activities that get meticulously tracked. We're talking about cash received, cash paid out, sales, purchases, and other daily activities. Basically, every single time a coin changes hands, or a product leaves the shelf, or a receipt is printed, you're essentially writing down a letter in the language of your business.
Moving right along to Section 2, reading financial statements, or as I like to call them, the stories.
So a balance sheet is exactly that. It's perfectly balanced. At the top, it shows what you own. These are your assets, things like cash, farm input inventory, property, that sort of thing. Then, down below, it shows what you owe, which are your liabilities, like accounts payable. So the crucial math here is just taking your assets, subtracting your liabilities, and that leaves you with your members' equity snapshot. It's a completely static picture, like a freeze frame of financial health at one single moment in time.
Now, let's look at the second story and see how this all builds. This is the income statement. If the balance sheet we just talked about is a photograph, well, the income statement is a video. It shows the story of performance over a period of time. Notice the flow we have going here. We start with total income earned from sales and services at the top, minus the total operating costs or expenses incurred in the middle, things like salaries and fuel. And the result? The net surplus or net income sitting right there at the bottom. It basically answers the ultimate question. Did we actually make money this month?
All right, Section 3, the 5 account types, which are essentially our vocabulary.
Here's a crazy thought. Every single business transaction fits neatly into one of these 5 core accounts. No exceptions. Let's make these abstract terms perfectly concrete with some quick examples. Assets are things of value you own, like farm inputs or a tractor. Liabilities are debts you owe to others, say a bank loan. Equity is the value left over for the members after all those debts are paid off. Then we have revenues, which are your actual earnings from selling goods or services. And finally, expenses, which are just the daily costs of operating. Rent, salaries, the electric bill, the whole shebang.
This actually brings up a super common point of confusion. What exactly is the difference between an asset and an expense if you're spending money on both of them? Let's put them head to head. An asset contributes to the current operating year and future years. Think of buying a delivery truck or a building. An expense, however, contributes only to the current operating year, like the fuel you put into that truck today or this month's electricity. Grasping this distinction? Absolutely a massive conceptual hurdle cleared.
Okay, bringing us to Section 4, the rules of accounting, which act as our grammar.
Now, depending on where you are in the world, these grammar rules are going to go by different names. In the Philippines, for example, they're called the Philippine Financial Reporting Standards, or PFRS for short. By definition, these are just the standardized practices and procedures that ensure accounting information is fair, free from bias, and reliable. For cooperatives specifically, they follow the amended framework prescribed by the Cooperative Development Authority. It just keeps everyone on the same page, perfectly standardized.
So let's group these grammar rules together to make them a bit easier to digest. First up, we have our baseline assumptions. The business entity concept just means you absolutely must keep the cooperative's affairs strictly separate from the individual owner's personal affairs. Don't mix them up. The continuing concern concept simply assumes the business is going to stay open and keep operating without interruption. And the consistency principle? Well, that dictates that you use the exact same accounting methods period after period, year after year. Next, we have the rules of evidence and cost. Now, the objectivity principle is pretty strict. Every single transaction requires cold, hard proof. You have to have verifiable source documents, like receipts, to prove exactly when it happened, what it was for, and how much it was. And tied directly to that is the cost principle, which basically means purchases must be recorded exactly at their original cost price, no guessing allowed.
Our third group covers time and recognition. The time period concept means we chop business life into specific financial periods, like a specific month or a specific operating year. The recognition principle dictates that we record revenue when it's earned and expenses when they're consumed, regardless of whether the actual cash has traded hands yet or not. And the matching principle? Well, that ensures we record an expense in the exact same financial period as the revenue it actually helped generate.
Finally, we have the vital guardrails of fairness and transparency. The conservatism principle ensures values are fair, reasonable, and absolutely never overstated or understated. The materiality principle says, hey, we follow all these rules unless a transaction's value is so tiny that it's just considered insignificant. And the full disclosure principle guarantees that all information about the financial situation is fully included in the statements. We're talking total visibility here.
Okay, I know that was a lot of heavy grammar, but here is the big picture palate cleanser. Why do we go through all the trouble of following this incredibly strict financial grammar? Well, the ultimate goal, plain and simple, is to produce financial information that is fair, totally free from bias, and entirely reliable. Because when you have that, you have a true picture of reality.
Which brings us to the end of our explainer. But it leaves me with a final, kind of provocative thought for you. Think about the language being spoken in your own organization right now. Are the financial stories of your own venture truly transparent, reliable, and free from bias? Because now that you understand the alphabet, the vocabulary, and the grammar of basic accounting, you are totally empowered to find out for yourself. Thank you so much for joining me today. And as always, keep learning.